Almost inevitable. That's the phrase Gary Shilling used on May 2nd to describe a U.S. recession arriving before the end of this year. And Shilling is not a guy who uses that phrase casually. In 1968, at age 29, he was Merrill Lynch's first chief economist. He forecast the 1969 recession. The CEO fired him for it. The recession came anyway, exactly when he said it would. He's now 88. He's been running his own forecasting firm for nearly 5 decades, and he just told Business Insider 3 things every homeowner watching this video needs to hear. 1. Stocks are heading for a 20 to 30% correction. And that's his words. No big deal by historical standards. 2. The housing market is frozen, and he doesn't see it thawing for years. 3. The American consumer is, again his words, on very thin ice. Stocks crash, housing freezes, recession inevitable. So today, I'm breaking down which of those 3 predictions is already happening as of this week's data. The specific dollar amount Cotality, formerly CoreLogic, just confirmed has evaporated from homeowner equity, and the one parallel to 1969 that makes this setup more dangerous for anyone who owns a home than anything since the Great Recession. Because if Shilling is even half right, the buyers, sellers, and homeowners who recognize what's happening right now will be in a very different position 6 months from now than the ones who don't. Here's what you need to understand about Shilling before we touch a single piece of data. This is a man who set up Merrill Lynch's entire economics department at 29, named a top Wall Street economist by institutional investors in 1975 and again in 76, ranked by the Wall Street Journal as the most accurate forecaster across 57 economists in 1997. He partnered with John Paulson on the subprime housing short before the 2008 crash and earned a 16-fold return. And in January 2006, his Insight newsletter ran an article titled "The Housing Bubble Will Probably Burst 18 months before it did." Now, here's the honest part. Business Insider noted in their own piece that Shilling has been cautioning investors about a potential recession for the last 4 years. So the fair question is, why is this warning different? The answer is in what he specifically called out. He didn't just say recession. He named 3 failures stacking on top of each other at the same moment. A frozen housing market, collapsing broader capital expenditures outside the artificial intelligence sector, and a consumer running out of room. And every single one is verifiable from primary data released in the last 30 days. Start with the one that hits homeowners and sellers directly, the frozen market. The National Association of Realtors released April 2026 existing home sales on May 11th. The annualized pace came in at 4.02 million homes, flat year over year. The number is roughly where we were in the depths of 2010, and it's the slowest housing turnover this country has seen in over 3 decades, despite the fact that the United States has roughly 6 million more jobs today than we did in 2019. Inventory is sitting at 4.4 months of supply. Median days on market, according to Realtor.com, climbed to 52 days in April, and the Mortgage Bankers Association reported the 30-year fixed mortgage at 6.46% as of the week ending May 8th, the highest level in 5 weeks. This is the freeze Shilling is describing, and the mechanism behind it is what makes this dangerous for sellers. According to Realtor.com data, sources from the Federal Housing Finance Agency's National Mortgage Database, 78% of all outstanding mortgages in this country are locked in below 6%. Half, 50.6%, are below 4%. So if you bought or refinanced between 2020 and 2022, the math of selling and rebuying at 6.46% simply doesn't work for you. But the buyers who are out there have lost their patience. The Mortgage Bankers Association released Q1 2026 delinquency data on May 14th. Total mortgage delinquencies rose 40 basis points year over year. ATTOM Data Solutions, also reporting on May 14th, showed foreclosure filings up 18% year over year in April, with completed bank repossessions up 42% year over year. Intercontinental Exchange Mortgage Technology's May Mortgage Monitor flagged 878,000 loans either severely delinquent or in foreclosure, the largest such volume since June 2018, outside the pandemic peak. That's the first prediction, already happening, confirmed by primary data this week. Real quick, if this kind of breakdown is what you want hitting your feed every week, smash subscribe and hit the notification bell. We're pulling primary data from the Federal Reserve, the National Association of Realtors, ATTOM, and Cotality, so you don't have to. All right, let's keep going. Is Shilling, the guy who saw 1969 coming when no one else did, drawing this parallel now? Let me paint 1969 for you. Inflation had crept from 1.2% in 1964 up to 5.4%. The Federal Reserve under William McChesney Martin tightened the federal funds rate from around 4% to a peak near 9.19%. The 10-year Treasury climbed from roughly 5% to nearly 8%. Stock valuations were stretched after a decade-long bull run, and the housing market had been hammered by the 1969 credit crunch. Mortgage money, in the words of historians at R Street Institute, was for most people unobtainable. Housing starts dropped roughly 25% in 1969. The S&P 500 peaked at 108 in November 1968 and bottomed at 70 by May 1970, a 33% decline. Now look at 2026. Headline CPI as of April is 3.8%. PCE inflation is 3.5%, well above the Federal Reserve's 2% target. The Federal Reserve held rates at 3.5 to 3.75% at the April 29th meeting, with 4 dissents, the most at a single FOMC meeting since 1992. The Shiller cyclically adjusted price-to-earnings ratio for the S&P 500 sits between 39.6 and 41.7. The second highest level in U.S. history, exceeded only by the dot-com peak. The Buffett indicator, market cap to GDP, is at 219%, and the housing market is the most frozen it's been in decades. That's the pattern. That's why Shilling is sounding this alarm specifically now. But here's the part of the parallel he didn't spell out. In 1969, when the recession hit, the Federal Reserve had room to pivot. By April of 1970, under Arthur Burns, they were already easing. That easing accelerated the housing rebound. Owners who held through the recession came out the other side. In 2026, the Federal Reserve doesn't have that room. With PCE inflation at 3.5%, the Fed cannot cut aggressively without reigniting inflation, and that means if a recession arrives, the mortgage rate cushion that bailed out homeowners in 1970, 2001, and again in 2020, that cushion is not coming this time. That's the one thing that makes 2026 more dangerous for homeowners than 1969. That's the part of the story no other channel is connecting. The second and third pillars stack on top of this, and they hit the consumer directly. Shilling told Business Insider that broader capital expenditures grew just 3.9% at the end of 2025, down from a pandemic peak of over 24%. Strip out the artificial intelligence sector, that number goes negative. Pantheon Macroeconomics confirmed in December 2025 that non-AI private fixed investment is in outright decline. And say it with me, wait. It gets worse. Bank of America research projects capital expenditures from 5 hyperscaler companies, Amazon, Alphabet, Microsoft, Meta, and Oracle, will exceed $800 billion in 2026. Goldman Sachs research notes that this hyperscaler Capex now consumes roughly 75% of those companies' cash flows, and Goldman's exact phrasing is that this is similar to tech company expenditures in the late 1990s. That's the dot-com analogy from Goldman Sachs on the record. Then the third pillar, the consumer. 3 numbers, none more than 2 weeks old. Number 1, the personal saving rate. Sourced from the Federal Reserve Bank of St. Louis, March 2026, 3.6%. The 20-year average is 5.9%. Number 2, University of Michigan Consumer Sentiment Preliminary, May 2026, 48.2. That's the all-time record low in a series that began in 1952. Lower than 2008, lower than COVID, lower than the 1980 recession. Number 3, the New York Federal Reserve Household Debt Report released May 12th. Credit card balances 90-plus days delinquent have climbed to roughly 12.3%, only about 1 percentage point below the Great Financial Crisis peak. Auto loan 90-plus delinquencies are at 5.2%. Within 0.06 percentage points of the all-time high set in Q4 2010. Except in 2010, unemployment was above 9%. Today, it's 4.3%. The last data point should keep every homeowner awake at night. The American consumer is breaking down at full employment. Here's our honest read. The biggest risk to American homeowners in 2026 is not a housing crash. It's a stock market correction that triggers a household consumption shock. Federal Reserve research from 2018 puts the consumption response at roughly 3.5 cents per dollar of wealth lost. The Federal Reserve survey of consumer finances shows that 58% of American households now own stock, the highest share on record, higher than the dot-com peak. A 25% S&P decline would erase roughly $12 trillion of household wealth. The resulting consumption pullback would hit retail, services, and ultimately the labor market. And homeowners who suddenly need liquidity would be forced into a frozen housing market with no buyers and a Federal Reserve that can't ride to the rescue. That's the chain. Most housing analysts have it backwards. They think housing breaks first and drags everything down. We think it's the other way this time. Tell us in the comments, are we wrong? Are you positioned for a stock-led correction that hits housing second, or are you in the camp that says housing breaks first? And if the 1969 parallel landed for you, hit the like button. That's how this analysis reaches more people who own homes and need to see it. So, the specific dollar amount we promised. Cotality, formerly CoreLogic, released their Q4 2025 homeowner equity report and confirmed something that has not happened in this entire housing cycle. Aggregate U.S. homeowner equity declined by $78.8 billion year over year, roughly $8,500 per borrower. For the first time in this cycle, American homeowner equity is shrinking. Florida homeowners lost an average of $29,400 per borrower year over year. California, $24,700. Arizona, $23,900. And Cotality ran a stress test most channels missed. If U.S. home prices fell just 5% from here, an additional 372,000 homes would flip into negative equity overnight. Now segment yourself, because the stakes are different depending on where you sit. If you own your home with substantial equity, you have more cushion than you think, but your paper wealth is not your liquid wealth. Cotality data shows tappable equity has flattened for the first time in 2 years. Home equity lines of credit have climbed for 13 consecutive quarters per the New York Federal Reserve. The people who can least afford a downturn are the ones who tapped equity in the last 18 months. If you're a seller, Redfin reported in February that there are roughly 630,000 more sellers than buyers in the U.S. housing market, the strongest buyers market in their tracked history. Miami has 148% more sellers than buyers. Austin, 112% more. Realistic pricing wins. Lennar's first quarter earnings call confirmed builder gross margins fell from 18.7% to 15.2% because they're carrying 14% in sales incentives, 3 times what they consider normal. If you're a buyer, and this part is actually optimistic, you may be looking at the best negotiating leverage in 15 years. D.R. Horton confirmed on their April 21st earnings call that 73% of their closings used mortgage rate buydowns. The big builders are doing the work for you. Use it. Here's the math, plain and simple. A $400,000 home at a 3.5% mortgage costs you about $1,800 a month in principal and interest. The same home at 6.46% costs you about $2,520. That's $720 a month, nearly $9,000 a year in pure interest going to the lender, not building equity. That's why sellers are stuck, why buyers are squeezed, and why this market is frozen. Hit subscribe so you don't miss the next video. Bottom line, Gary Shilling has been wrong before. Bears get loud at the top of every cycle. The April jobs report came in at 115,000, better than expected. FactSet shows Q1 corporate earnings up roughly 28% year over year, the strongest since Q4 2021. Goldman Sachs puts U.S. recession odds at 25%. JP Morgan at 35%. Morgan Stanley has no recession in their base case. The bulls have real ammunition. But Shilling's argument is not that everything looks bad. His argument is that this specific combination of signals, saving rate at 3.6%, Shiller PE at 39, frozen housing turnover, non-AI Capex in decline, consumer sentiment at an all-time low, credit card delinquencies near GFC levels, has only ever shown up in one comparable moment in modern U.S. history. And that moment was 1969. The man who called 1969 is calling this one too. He may be wrong, but the cost of ignoring him, if he's right, is measured in tens of thousands of dollars per household. For the American homeowner in 2026, this is the slowest moving wealth event in modern memory. Equity quietly evaporating one quarter at a time while the surface looks calm. The headlines won't catch it. Your monthly Zillow estimate won't catch it. But the primary data from Cotality, the Federal Reserve, ATTOM Data Solutions, and the Mortgage Bankers Association already has. You just have to know where to look. That's what this channel does every week. Subscribe and hit the notification bell so you see the next video the moment it drops. I'll see you there. Need a voice that sounds real, experienced, and actually connects with people? I'm Jeff, a professional voiceover artist with decades of experience in commercials, narration, radio imaging, promos, and a lot more. Whether you need warm, dramatic, conversational, or high energy, I'm your guy, not AI. Email the channel for more info on how I can bring your voiceover project to life.